In part one, we discovered the mindset of Peter Lynch and the importance of investing in what you know. In part two, we explored his 6 stock categories and how each has its own risks and rewards. Now in part 3 of One Up on Wall Street, we're diving into the heart of Peter Lynch's method, how he actually picks winning stocks, and how you can too. Let's get started. Peter Lynch didn't rely on Wall Street analysts or complex trading software. He relied on research, observation, and common sense. He believed that the average investor could beat the pros if they simply did the work. So what kind of work was Lynch doing? He followed a clear process, and it starts with finding an idea. 1. Where Lynch found stock ideas. Lynch believed the best stock ideas come from the world around you. Shopping malls, your job, your kids, new products or services you notice before Wall Street catches on. He called this investing in what you know. Let's say you notice a new coffee chain opening in your city, and it's always packed, or your kids are suddenly obsessed with a new toy, brand, or app. These are signals. Peter Lynch paid attention to them before anyone else. But finding the idea is just step 1. 2. The importance of doing your homework. Once you spot an interesting company, Lynch says it's time to dig in. He read annual reports, earnings statements, and studied the company's balance sheet. Here's what he looked for. Earnings growth. Is the company growing profits year after year? Low debt. Companies with low debt can weather downturns better. Strong cash flow. Can the company fund itself without constant borrowing? Simple business model. Does it do one thing very well? In Lynch's own words, never invest in any idea you can't illustrate with a crayon. If the business is too complex, skip it. You're not trying to impress anyone. You're trying to make money. 3. Know what you own. This might be the most repeated lesson in the book. Know what you own and why you own it. That means understanding what the company does, how it makes money, what factors could hurt its growth. Lynch would often quiz himself. If he couldn't explain the company in 1 or 2 sentences, he wouldn't invest. So let me ask you, can you explain the stocks you own in 1 sentence? If not, take a closer look. 4. Looking for the Tenbagger. A Tenbagger is a stock that goes up 10 times in value. Peter Lynch was obsessed with finding Tenbaggers. And here's what they often have in common. Small cap or mid-cap companies, not giants. Rapid earnings growth. Little or no attention from Wall Street. A simple, repeatable business model. Plenty of room to expand geographically or into new markets. He wasn't looking for hype. He was looking for undervalued growth. Stocks the market hadn't discovered yet. This is where the real magic happened in his portfolio. Now, before you rush out and buy the next small cap stock you see, Lynch gives us a few cautionary rules. 5. Don't chase short-term noise. Wall Street lives and dies by quarterly earnings. But Lynch reminded us, the stock market is not the economy, and short-term fluctuations don't matter. He ignored hype, panic, and media noise. Instead, he focused on a company's long-term performance. That's where his edge came from. Patience. 6. What to watch for in a company. Lynch listed several positive signals. A boring name? Yes, boring companies often make the best investments. An unpleasant business? Think waste management or pest control. Insiders buying stock? A sign of confidence. A niche with little competition? Companies that repurchase their own shares? Shows financial strength. And he warned us about red flags. High debt, sudden spikes in earnings with no explanation, companies diversifying too far from their core business. In other words, stay grounded. If something seems too good to be true, it probably is. 7. When to sell a stock. Buying is only half the equation. Lynch was also clear on when to sell. Sell when. The reason you bought the stock is no longer true. The company's fundamentals change for the worse. The stock becomes overhyped and overpriced. You discover better opportunities elsewhere. But don't sell just because the stock dipped. Peter Lynch didn't panic during drops. He used them to buy more if the fundamentals stayed strong. So let's recap Lynch's approach to picking stocks. Observe the world around you, research the business, Understand what you own. Look for undervalued growth. Ignore short-term noise. Buy strong companies at the right price. Hold for the long run. If you follow those principles, you're already ahead of most investors. In Part 4, we'll wrap up the series with Peter Lynch's personal philosophies on emotions, market timing, and why simplicity wins. Make sure you're subscribed so you don't miss it. And if you found this breakdown helpful, please like the video, share with a fellow investor, and check the description.